Good day! We are the Group 14 and our topic is all about insurance law.
Insurance law. Insurance is very useful for companies engaged in the tourism industry because there are many kinds of risk in enterprises where investments oftentimes is quite substantial. By way of example, an employer may subscribe to a group insurance of his employees as part of its employee benefit program. Companies utilizing building structure for operation of their hotels, restaurants, and other tourism-related establishments may think of investing in property insurance against fire and earthquake to protect their investment. Lastly, an investment in marine insurance, the usual practice among companies engaged in the transportation of cargoes at sea, may also be worth looking at. The law. Section 2. A contract of insurance is an agreement whereby one undertakes for a consideration to indemnity. Another term for indemnity is security or protection. Protection another against loss, damage, or liability arising from an unknown or contingent event. Ang insurance law mo ni ang mo kanang mura siya o contract na if naay mahitabo makatabang siya nga mo gasto nimo. Discussion of the law. The essential elements of an insurance contract are: A. Insurable interest. The interest that a person has in something such as a particular property or another individual, which means that the person would suffer a loss should that property or an individual be harmed. Existence of risk. So, existence of risk, maybe mura ni siya kanang padayon bisa na ganang risgo. So, a legal doctrine under which an individual is barred from recovering damages for an injury sustained when he or she voluntarily exposed him or herself to a known danger. So, siya mismo ang nisulti or ni-expose sa mga mahitabo or mahitabo. So, kanang mura siya o siya may nagsulti na gani nga kana mahitabo jud. Kanang kabaw na siya nga mahitabo. So, C. Assumption of an such risk by the insurer. It is a common law defense that has been used to pass the responsibility for loss or injury onto the injured party by assisting that the individual has had knowledge and understanding of the hazard involved in the undertaking and is therefore not entitled to recovery. So, mura ganin niya gipasa ang nahitabo sa katong na injured na person. So, mo ni siya. Then D. Said assumption being part of a general scheme to distribute equal losses among those bearing similar risk. So, E. Payment of premium. So, payment of premium kay kuan is the insurer by the insured for covering his or her risk. So, mura siya mo'y mubayad sa mura siya payment of premium ba mura siya mo'y mubayad sa na-injury. The characteristic of an insurance contract are: A. Aleatory. There is an element of risk. An aleatory contract is one where the obligations depend upon the occurrence of an uncertain event, such as in the case of a fire insurance, or one certain to happen but at an indeterminate time, such as death in life insurance. Example na ini ang insurance policy. So, kana ganing ang insurance pinanglita na isunog. So, iniguman gani o sa sunog, sila mismo ang mubayad sa mga nasunugan sa katong nagkuan o contract sa aleatory contract. B. Contract of indemnity. There is an exchange of value for value, particularly in property insurance. Example, si person A promises to deliver certain goods to person B for 2,000 every month. So nag-deliver siya og mga goods like mga pagkaon. Person C comes in and promise to indemnity B's losses. So kana ganing murag pinanglitan na ay failure sa pag-deliver ni person B. So si person C maoy ni promise nga tabangan niya si person B og deliver sa goods. So this is how B and C will enter into a contractual obligation of indemnity. Mo na siya. C. Onerous. Onerous or onerous? Basta. There is valuable consideration given payment of premium. So, pinanglitan, mag-abang, kana ganing mag-abang kag butang, bisan dili nimo kinahanglan niya. Dili dayon nimo maako, kay tungod, dili pa nimo kinahanglan. So, D. Bilateral. Both party are bound to do something. So, pinanglitan, mipalit ka og sakyanan. So, ang katong imong kasabot, kung mabayad ka sa sakto, ihatag jud niya ang kanang imong titulo sa sakyanan. So kana ganing magkuan ba exchange. Next, E, formal. So formal, as to form a policy is required to be issued and the premium must be paid. So example ani kay real estate, marriage license, and non-disclosure agreement. The parties in an insurance contract are A. Insurer, a person, partnership, association, or corporation duly authorized to transact an insurance business. So example, it is the party in an insurance contract that promises to pay compensation. So siya mo'y mubayad sa iyang kapartner, kung kinsa iyang kapartner sa katong nga contract. B. Insured, a person with an insurable interest who stands to benefit from a policy of insurance. In its strict sense, the insured party is the owner or purchaser of the policy, even though benefit of the insurance may accrue someone else. So example, nay usa ka empleyado gani while nagtrabaho siya, nakaguba siya og lain nga butang sa usa ka empleyado or kana ganing nilaag dito, nilaag niya nakaguba siya murag nakadasmag. So ang mobayad ana kay ang kumpanya, kay insured naman siya. So usa siya ka insured. So in short, ang policy sa iyang kumpanya mao'y mobayad sa iyang naguba. C. Beneficiary, a person designated by the terms of the insurance policy upon the happenings of the event insured against. It is the person named in an insurance policy as the one to receive, proceed, or benefits occurring thereunder. So example na ini kay spouse, partners, mga anak, parents, brothers, sisters, business partners, key employee, kanang trusted person, and charitable organization. Insurance contracts may refer to the following. A. Life insurance, an insurance on human lives and insurance appertaining thereto or connected therewith. So, why it is important? So, ano din importante nga magkuha life insurance? Buying life insurance protect your spouse and children from the potentially devastating financial losses that could result if something happened to you. It provides financial security, helps to pay off debts, helps to living expenses, helps to pay living expenses, and helps to pay any medical or final expenses. So ang life insurance mo dinhi unta pinakagamit kung nalang kay kwarta nga ikakuha ani kay mo ni makatabang if ever maglisod na kasi mong kinabuhi gani like magamit jud mo siya. Next, B. Fire insurance, which includes loss by fire, lightning, windstorms, tornado, or earthquake, and other allied risks. When such risks are covered by extension to fire, insurance policies or under the separate policies. So kanining if naay mga sunog or mga peligro gani nga dili na to mabantayan, so makatabang ni siya if ever naglisod ta. C. Marine insurance. A contract whereby one for a consideration agrees to indemnify another for the loss or damage on a certain interest subject to marine risk by certain perils of the sea or specified casualties during a voyage or fixed period. So if ever example ani kay seaman kada ganing if ever kanang mas masamad siya dito or maputol yung kuan, so na siya marine insurance. So ang mga seaman na po dahil sila marine insurance. D. Personal accident insurance. An insurance which provides pecuniary compensation for expenses or losses of income brought about by death or bodily injury arising from violent, external, visible, and accidental means. So kani di ay mo ni siya ang kanang pinangitan nga disgrasya ka. So if ever nagkalisod ka ana nga disgrasya, magamit nimo ang personal accident insurance.
These are the guide questions about our topic about insurance law. So number 1 is, what is the concept of insurance? The concept of insurance revolves around the transfer of risk from an individual or entity to an insurance company in exchange for a premium. Insurance provides financial protection against potential losses or damages that may occur in the future. So here's how it typically works. First is the policy holder. The person or organization seeking insurance coverage is known as the policy holder. They purchase an insurance policy from an insurance company. Second is the insurance policy. The insurance policy is a legal contract that outlines the terms and conditions of the coverage provided by the insurance company. It specifies the types of risks covered, the duration of coverage, the premium amount, and any deductibles or limits. Third is the premium. The policyholder pays a premium, which is the amount charged by the insurance company for providing coverage. Premiums can be paid in various ways, such as annually, semi-annually, or monthly. Next is the risk assessment. Insurance companies assess the risk associated with insuring the policyholder. They consider various factors such as the probability of a loss occurring, the potential severity of the loss, and the policyholder's history of claims. Next is the policy of risk. Insurance companies pool together the premiums collected. Pooling of risks. Insurance companies pool together the premiums collected from policyholders to create a fund that can be used to pay for covered losses. This spreads the risk among a large group of policyholders, ensuring that no single individual bears the entire burden of a significant loss. Next is the claims and losses. If a covered loss occurs, the policyholder can file a claim with the insurance company. The insurance company investigates the claim and if approved, provides compensation or reimbursement as per the terms of the policy. This helps the policyholder recover from the financial impact of the loss. Next is the risk management. Insurance plays a crucial role in risk management by providing individuals and businesses with a means to protect themselves against unforeseen events. It helps mitigate financial risk and provides peace of mind by offering a safety net in case of accidents, property damage, liability claims, healthcare expenses, and other covered losses. Next is the Common types of insurance include auto insurance, home insurance, life insurance, health insurance, business insurance, and liability insurance. The specific coverage and terms vary depending on the type of insurance and the policy chosen. It's important to note that insurance is not meant to be a profit-making mechanism for policyholders. Instead, it aims to provide financial protection and help individuals and organizations recover from losses that could otherwise have a significant impact on their lives or operations. Number 2 is, what are the advantages of insuring the company's assets and key officers? Insuring a company's assets and key officers can provide several advantages, including first, asset protection. Insurance coverage helps protect the company's physical assets such as buildings, equipment, inventory and other property against risks like fire, theft, natural disasters, and vandalism. In case of any damage or loss, the insurance policy can provide financial compensation to cover the cost of repair or replacement, minimizing the impact on the company's finances. Next is the business continuity. Insuring key assets ensures that the company can continue its operation even in the face of unexpected events. For example, if a fire damages the company's production facility, insurance can provide funds to set up a temporary location, repair the damage, or replace the necessary equipment, and allowing the business to resume operations more quickly. Next is the liability protection. Insurance coverage also protects the company against liability claims arising from accidents, injuries, or damages caused to third parties. This includes coverage for legal expenses, settlements, or judgments, reducing the financial burden on the company in the event of a lawsuit. Next is the key person insurance. Key person insurance is a type of coverage that protects businesses from the financial impact of losing a key executive or employee. If a key officer, such as the CEO or a top salesperson, becomes seriously ill, disabled, or passes away, key person insurance can provide funds to cover the cost of hiring a temporary replacement, recruiting and training a new employee, or compensating for the loss of revenue or businesses opportunities resulting from the absence of the key person. Next is the risk management and peace of mind. Insurance allows companies to transfer some of the risk they face to an insurance provider, providing a sense of security and peace of mind. By having appropriate coverage in place, business owners and key officers can focus on the core responsibilities without constant worry about potential financial losses from unforeseen events. Next is the enhanced credibility. Having insurance coverage can also enhance the credibility and reputation of a company. It demonstrates to clients, partners, investors, and other stakeholders that the company has taken proactive steps to mitigate risk and protect its assets and key personnel. This can help build trust and confidence in the company's ability to fulfill its obligations and deliver on its promises. It is important for companies to carefully assess their insurance needs and work with an experienced insurance professional to determine the most suitable coverage options based on their specific industry, operations, and risk profile. Number 3 is, what is the contract of adhesion? The contract of adhesion is a legal term that refers to a type of contract where one party has significantly more bargaining power than the other, resulting in an unequal distribution of rights and obligations. In such contracts, the terms and conditions are typically drafted by one party, referred to as the adhering party or party of superior bargaining power, while the other party, referred to as the adhering party or party of inferior bargaining power, has little or no opportunity to negotiate or modify the terms. These contracts are characterized by their standardized, pre-printed form and take it or leave it nature. They are commonly found in various commercial transactions such as insurance policies, rental agreements, software licenses, and consumer contracts. Examples include terms or conditions presented to users when signing up for a software or the fine print in insurance contracts. Number 4 is what are the insurable items in a tourist-oriented company. A tourist-oriented company may have various insurable items depending on the nature of its operations. Here are some common insurable items for such a company. First is the property and buildings. This includes insurance coverage for the company's office buildings, hotels, resorts, tourist attractions, and other physical properties. It protects against risks such as fire, theft, natural disasters, and vandalism. Next is equipment and assets. Insurance can be obtained for equipment and assets used in the company's operations such as vehicles, boats, buses, tour vans, audio-visual equipment, computers, and other specialized equipment. Next is the liability insurance. This type of insurance protects the company against legal claims arising from injuries or property damage caused to third parties. It can cover incidents that occur on the company's premises during transportation or during guided tours and activities. Next is the business interruption. This coverage helps compensate for financial losses due to unexpected interruptions in business operations, such as closures or disruptions caused by natural disasters, strikes, or other unforeseen events. Next is the professional indemnity. If the company provides specialized services like tour guiding, travel, planning, or consultancy, professional indemnity insurance can protect against claims related to errors, omissions, or professional negligence. Next is the workers' compensation. This coverage is essential if the company has employees. It provides benefits to employees who suffer work-related injuries or illnesses, covering medical expenses, disability benefits, or lost wages. Travel insurance. If the company offers travel packages or sells tickets, it may consider offering travel insurance to customers as an add-on option. Travel insurance typically covers trip cancellation or interruption, medical emergencies, lost baggage, and other travel-related risks. Next is the cyber insurance. In the digital age, tourist-oriented companies often store sensitive customer data and rely on online systems for bookings and payments. Cyber insurance helps protect against losses resulting from data breaches, cyber attacks, or other cyber security incidents. It is important for a tourist-oriented company to assess its specific risk and consult with insurance professionals to determine the most appropriate coverage for its operations. Insurance needs can vary depending on the size of the company, its geographical location, the types of services provided, and the local regulatory requirements. Number 5 is what in an insurance contract. An insurance contract is a legally binding agreement between an insurance company, the insurer, and an individual or the entity, the policyholder, in which the insurer agrees to provide financial compensation or coverage for specified losses or risks in exchange for the payment of premiums. It is a means of transferring risk from the other policyholder to the insurer. The insurance contract outlines the terms and conditions of the insurance policy, including the coverage provided, the premium amount, the duration of the policy, and any limitations or exclusions. The policyholder pays regular premiums, typically on a monthly or annual basis, to maintain the insurance coverage.
Number 6, what are the essential elements of an insurance contract? The essential elements of insurance contract typically include the following: other and acceptance. The insurance company makes an offer to provide insurance coverage that and the insured policyholder accept the offer of the agree to pay the premium. Important to note that specific element of insurance control may vary depending on the type of insurance and the law of a jurisdiction in which. Number 7, what are the characteristics of insurance contract? The characteristic of an insurance contract can be summarized and follows. Risk transfer insurance contracts are primarily designed to transfer the risk of potential losses from the insurance to ensure the insured pays and premium to insured in exchange of. Important to note that the characteristic of insurance control may vary depending to the type of insurance and the specific terms to a condition of policy. Number 8, what are the parties in insurance contract? The parties to insurance contract are following: insurance company. Insurer, the party that provides the insurance coverage and assumes that risk of potential losses. Insurance companies are licensed entities that specialize in underwriting and managing risk that they collect premium from the insured and are responsible for paying claims and accordance with the terms and conditions with the assurance contract. It's important to note that the role of responsibility of the parties may vary depending on the type of insurance or the specific terms and conditions outlined in insurance contract. Number 9, give example of insurance contract. Here's some common example of insurance contract. Auto insurance. This type of insurance provide coverage from potential losses or damage resulting from accident involving automobiles. It typically includes liability coverage from badly injured and property damage to third parties, as well as coverage for insured's own vehicle in case of theft, damage, or their coverage. First, these are just a few examples in insurance contract. There are numerous of other types of insurance available to center to different needs and risks. It's important to carefully review the terms of condition of each specific. Number 10, what are insurable interest? Insurable interest refers to legal or financial interest that person or entity must have the subject matter of insurance contract in order to obtain insurance coverage. It is a fundamental principle in insurance that ensure that validity and enforceability of contract. Its sample term insurable interest means that insured must stand to suffer financial losses or have a legal or financial relationship to insured property or person. The requirement exists to prevent situation where someone could potentially profit from the loss of misform of other party.
Number 11 is what is the difference between insurable interest in property insurance and the insurable interest insuring the life of another other than himself. Insurable interest refers to the legal and financial stake an individual or entity has in insuring a particular person's life or property. It is a fundamental principle in insurance contracts, ensuring that the insured party has a genuine interest in protecting the subject's matter being insured. When it comes to property insurance, insurable interest relates to the ownership or financial interest that a person or organization holds in the insured property. The individual or entity must have a direct financial stake in the property to obtain insurance coverage. For example, a homeowner has an insurable interest in their own house because they own it and would suffer a financial loss if it were damaged or destroyed. On the other hand, insuring the life of another person requires a different type of insurable interest. In this case, the person seeking life insurance must have a legitimate financial interest in the insured individual's life. Typically, insurable interest exists between family members, business partners, or creditors and debtors. The purpose of insurable interest in life insurance is to prevent individuals from obtaining life insurance policies on the lives of people with whom they have no relationship or financial interest. Without insurable interest, life insurance could be exploited for malicious purposes such as speculating on someone's death for personal gain. Number 12. What is group insurance? Group insurance is a type of insurance coverage that is offered to a defined group of individuals, typically through an employer or an association. It provides insurance protection to members of the group collectively as opposed to each individual obtaining their own separate policies. Number 13. What is marine insurance? Marine insurance is a type of insurance that provides coverage for risks associated with maritime activities such as transportation of goods and cargo by sea, inland waterways, and air. It is designed to protect the interests of businesses and individuals engaged in marine-related industries, including shipping companies, cargo owners, freight forwarders, and shipbuilders. Number 14. What is fire insurance? Fire insurance is a type of property insurance that provides financial protection against damage or loss caused by fire. It is designed to cover the costs associated with repairing or replacing property such as buildings, structures, and their contents in the events of fire-related incidents. Number 15. What is compulsory motor vehicle insurance? Compulsory motor vehicle insurance, also known as mandatory auto insurance or third-party liability insurance, is a type of insurance coverage that is required by law in many countries and states. It is designed to provide financial protection to individuals who may be injured or suffer property damage as a result of an accident caused by the insured vehicle. The purpose of compulsory motor vehicle insurance is to ensure that individuals involved in accidents are financially compensated for their losses regardless of who is at fault. It helps protect the interest of victims by providing them with a source of compensation for medical expenses, property damage, and other related costs.